Hugo wants 200, baby.
You ready to get back to the trading action?
You aim, you shoot, and make money.
It's going to be a great day. You guys know where you're at. All right, guys, welcome. I have a banner over my face. Let me fix that real quick. There we go. Welcome, everybody. Good to see you in here. I see you, DJ 2 a.m. Awesome. Okay, we are cooking here. So welcome, everybody. I am broadcasting from the road this week, but I just could not get away from these. You know, I needed to get the next week in there. I didn't want to keep you waiting 2 weeks. We're 2 weeks into our 6-week foundation mastery series here. So first week we talked about a lot of the basics of building a system, getting a nice foundation, and we had some homework that we'll check in on. But this week we're getting into the fun stuff here. We're getting into the essentials of chart reading. We're talking supports, resistances, and trend lines that actually work. Okay. So, you know, there's a lot of material out there, and I'm not saying it's bad, but I think a lot of what's missing is often the reasons why these fundamental concepts actually work. So we're going to be trying to get you to understand the why, so that it becomes a lot clearer and it'll pop out at you on the charts and really help your holistic knowledge of this kind of stuff. So, hey, Ayush, good to see you in chat. Welcome, guys. Welcome. All right. So let's get right into it here. All right. So this is part 2. Like I said, we're going to be getting into some good stuff. It is, it's going to be a lot that I'm throwing at you, but I think that you guys can handle it. It's kind of like basic concepts, but we're going to really dig in deep to them. So first off, anybody in chat do their homework? Did we, last week we talked about the 7 fundamental points of building a trading system. So if anybody did, I'd love to hear about it either in chat or maybe in Discord, and I'd love to talk about that with you. But I just wanted to check in on you guys. You know, as a good teacher, I gotta make sure you're doing the work. So we talked about completing that personal plan, and if you guys have any questions on the personal plan, you can either put them in the sidebar, or like I said, we have a good community in the Discord, and I'd love to see some more feedback there, and we can really work through any problems you might be having. So now that we've gotten the boring stuff out of the way, now that we got the boring stuff out of the way, we're going to get into the good stuff here. So today we're going to learn a bunch of stuff. We're going to learn how to develop X-ray vision for charts. We're going to be able to see what let's call it 90% of traders have trouble seeing in terms of identifying these basic concepts, but in a more nuanced way, in a way that's actually more applicable to consistent profitability. Because remember, that's what we're all about here. We're building a system for consistent profitability. So we're going to get into the psychology behind this technical analysis and why it works, because I think it's super important for any concept, no matter whether it's trading or otherwise. It's one thing to know the rules, but it's another thing to know why the rules are in effect, right? And I don't know about you, but I'm a lot more inclined to follow rules if I understand why they're important. So I think that's going to be a key component today. And then going into the actual technical stuff, we're going to get into support and resistance mastery, really solid understanding of why these things happen, how they do, and how we can trade them. We're going to get into trend line trading, which actually works, because there's a lot of misinformation, I feel like, about trend lines. And they are valuable, but they are not the end all be all. They are an essential part of chart reading, though. So I want to get into that. And I want to get into some pattern trading as well. Some common patterns that you'll start to see as you look at charts, and just how you should be kind of approaching them when you do see them. So after that, we're going to get into a little live analysis. Depending on how much time we have, we can hop into any charts that you guys choose, and we can apply these concepts in real time. I really love doing that. So hopefully we have some time to do that. I think we will. And that should fill up this session. You know, we're going to really focus on these items, especially the psychology. I think that's the most important. So that's what we're doing today here. And let's hop right in. So first off, I just want to talk about how we can integrate this stuff into the trading plan that we made last week. Because as you guys know, this is a series. I want it to be cohesive, and I want it to be building upon it each week so that we can really build up a solid foundation and have some tangible stuff to work with here. So last week we were building that foundation, and this week we are building the frame, if we're using a home building analogy, right? Metaphor. So we got our solid foundation to build these concepts on. We talked about entries and exits and how important they are, but we haven't talked about the specifics in terms of these actual entries and exits and how they interplay with technical analysis on the charts. So we're linking this all together. We talked about different strategies that you could employ, and this week we're really focusing on technical analysis methods. So what is TA, right? Just to keep it super simple, it's just basically using the price action of a chart to help insights on future action. So most indicators, dare I say all indicators, barring a very few, are going to be backwards looking, right? So new data comes out, and this could totally change the trajectory of the chart. But what we're focused on is the high probability that a trend that's established will continue, or a pattern that's established will play out. So because of that, technical analysis, despite what some people may say, it does have a very high success rate. You can absolutely be a purely technical analysis-based trader and do very well. I think optimally, you do have some fundamental analysis built into your system. And so that's why last week we talked about marrying the two. But this week we're going to be sticking strictly to the technicals. And that's probably a good thing, because that's definitely my wheelhouse. That's the kind of trader I've been since I started. I'm working on building more of a fundamental analysis understanding, but you're getting the best of me here. So we're going to talk about those exit and entry rules, the specifics based on the charts, and what the signals are that we should be looking for. And I just wanted to put this quote here because I think it's really important. Your trading plan tells you what to trade, but technical analysis tells you when. So we identify a good potential trade via a number of factors, and then the technical analysis that'll know when you should get in. That'll help you figure out when to get in and when to pull the plug if it doesn't work, and when to ring the register if it does work. So it works because markets aren't moved by fundamentals alone. They're really moved by human reactions to those fundamentals. So if everybody is expecting a catalyst, maybe it doesn't actually supersede the expectations, and maybe it's a sell the news event, right? It could be a bullish fundamental change, but if everybody is expecting something greater, maybe it doesn't play out, or vice versa. Maybe bad news gets absorbed. We've seen that a lot. Stuff like Iran war threats are just getting absorbed for the most part in the tape. People are buying these dips, and we can speculate till the cows come home on why that is. But the great thing about technical analysis is that we don't have to. So technical analysis is great because we are crowdsourcing fundamental analysis through one easy to view window, right? So a chart it's basically telling us what the collective psychology of the market is on any given asset. So when SPY goes up, the market is telling you it's bullish. It wants to go up, right? It's pretty simple, right? If we get stuck in the weeds of fundamental analysis, we could stay up all night trying to figure out the hows and the whys of what is making SPY move up. But at the end of the day, it's all moving up because there are more buyers than sellers. So I think that if you're just getting into trading, or even if you're a seasoned professional, it still takes so much less mental power to analyze a chart than it does to analyze an industry or a market. These complex systems are very tough. So when we can boil it down and kind of bottleneck it into one aspect of our strategy that we can focus on and hone, it really does get you the best bang for your buck in terms of time investment. So that's why I'm a big technical analysis guy. I think it's an absolutely essential part of any skill set. I know some traders don't use it at all. They think it doesn't work. It's not real. But once you see it, you can never go back. Let's put it like that. So technical analysis is essentially showing fear and greed. Every price movement represents somebody's fear or somebody's greed, right? Does that make sense? We got exuberance on the tape when things are imbalanced, when there are a lot more buyers than sellers and the price just expands upwards. We have panic on the tape when the same happens in reverse. And when we are moving sideways, we're basically in a wait and see period where the previous move, whether it was up or down, is being digested, and we're deciding collectively as a market whether we want to extend this move or whether we want to reverse this move. So it's all in the charts. That's what I always say. It's all in the charts. Everything you could possibly imagine, all of these different factors that contribute to stock movement, it all needs to be reflected in the charts. So you focus on that. You don't have to worry too much about all of the fundamentals. So I want to talk about information theory a little bit, and that is that price is the ultimate consensus of all available information. Like I said, we are crowdsourcing all of this fundamental data from all these investment firms, all these all the trade desks at JPM and Goldman Sachs, and we're cutting out the middlemen. We're saying, hey, if they're bullish, it'll show on the charts. If they're bearish, it'll show on the charts. So because of that, I think that technical analysis is kind of the holy grail in terms of what you should be focusing on your time on for trading. So another thing is pattern repetition. So the same psychological patterns repeat because human nature doesn't change. And this is super cool. This was mind blowing to me. And one of the biggest kind of hooks that got me so fascinated with technical analysis early on, you could look back at like the original invention, you could say, of candlestick charts in Japan. They were trading, rice harvests. And it's so crazy looking at some of those old charts and saying, hey, look, that's a flag breakout. That's an ascending triangle. It was hundreds of years ago. And yet this exact same patterns, the exact same principles, they still apply. Because at the end of the day, no matter how many algorithms are trading, however many quantitative systems the market is working through, it's still a supply and demand, and it still portrays itself in the same patterns. So it's very, very cool stuff. And, just want to talk about statistics because studies show that 70 to 80% of short-term price movement is driven by market psychology. So that's where you could have a really good fundamental case for something. But if the market isn't ready to buy, if they're not ready to light that fuse, it simply doesn't matter. A great example of this is really early on in my trading career. I was trading Zim, which is a shipping company. And I had these buddies who were really, really top notch at fundamental analysis. And they're telling me this thing should be triple the price. And every day was just selling. And I could not figure out why. And, I got shook out once before I realized, hey, the market it's just an unloved stock right now. The market doesn't care, So if the market doesn't care, there's no liquidity, and shorts just have their free will to kind of push the thing around. So because of that, I had to wait for the technical setup to align with the fundamental bull thesis. And once the technical setup showed a proper basing formation, then I tried again, and lo and behold, the fundamental guys were right. It tripled, So it's really important to temper your expectations if you're a purely fundamental trader, and to start to expand your repertoire into this technical analysis, so you can align the two concepts and really get the most bang for your buck. Otherwise, you might be sitting in a trade that fundamentally should be going higher, but you could get dragged. Maybe you have conviction, and the worst thing that happens is the opportunity cost. But usually people get scared out or bored out when something doesn't work how they expect it to. So that's why technical analysis works. And that's this is probably my favorite slide of the presentation, because I think it's so important to understand this stuff. If there's any part you want to rewatch, this is probably the most important, because it's simply it's explaining the why instead of just, oh, well, when you get a bullish crossover of the 9 and the 21 EMA, you can project a X% move, and all that kind of nonsense. It's you lose touch with the whys, So that's why I wanted to focus on this. So there are 3 pillars to chart reading. This is kind of arbitrary. I liked the idea, so I went with it. There are 3 ones that jump out to me the most, and I think that they provide a really strong foundation to build upon, just like pillars. So, we have support and resistance, which is where price matters most. They're the levels of interest, institutional and otherwise, where price responds to. So being able to identify those levels and trade off of them is super key. The next is chart patterns, which is basically going to tell us when to take action. We're seeing a pattern develop, and these patterns have breakpoints, essentially. For example, when an ascending triangle breaks out of that base that it's been building and building and building, that's when you should take action, right? So it gives you an actionable time for these trades. The support and resistance gives you actionable levels. Chart patterns give you actionable time. And then trend analysis in general, which is kind of like a higher zoomed out look, which helps really inform you on the directionality of a given stock. So that would be like a different time frame analysis, and making sure there's cohesion between the higher time frames and the lower time frames before you take a trade on those lower time frames. And they're all super important. They all work together, and they'll all help you build a cohesive strategy. So going forward, we are going to be talking about more specifics. We're going to be talking about a step checklist that you can use, and you can build into that framework that we built last week of our trading system. And we can just keep fleshing that out week on week with this new information. So going for, a few slides later, we'll talk about that, about the actual steps, but I just want to put it on your radar. Like, this is kind of this is the trajectory here with this this series that I'm doing. I want to give you a base and then keep building it out and building it out, and you'll feel more and more confident. You'll have more tools at your disposal, and it'll really, really improve your win rate. I firmly believe. So moving on here, let's talk about some support and resistance. So this is the foundation. Remember, it's the most important, and I wanted to start with it because I think it's significantly more important than trend lines for trading. And let me tell you why. So support and resistance, they operate on obviously horizontal levels, right? They're on horizontal levels, and they're associated with specific prices. And price memory goes back literally decades. So if a level was notable 10 years ago, it will still be notable today if price interacts with that level. I know this sounds like, voodoo or something, and it feels like voodoo when it works, but it's absolutely just super, super cool to watch this stuff play out. For example, gold. I don't know if any of you are gold bugs like me. I was so bullish on gold about a year and a half, 2 years ago. And the reason why is because it was flipping a 30-year long resistance into a support. And it was a beautiful cup and handle pattern with a projected move to 33 to 3,500, I believe. And lo and behold, look at that massive gold run we've had, just straight up into the right. So when a really notable support or resistance line flips, you'll get a really notable move. So it's more important than trend lines, because trend lines are much more arbitrary. It depends on whether you're drawing from the bodies of the candles or the wicks, and every single day that resistance or support moves as the diagonal level changes, right? So because of that, they're important, but they're not nearly as important as support and resistance. So let's just get into the definitions really quickly here. So the definition of a support is when a price level where buying interest consistently exceeds selling pressure. So that just means when price comes down to this level, you will find more buyers than sellers, and it will contain the downside move. And on the other side, a resistance is when a price level where selling interest consistently exceeds the buying pressure. The same thing. So a good example of this is Amazon at 200. When it was first testing 200, it just bopped its head there once, twice, 3, 4, 5 times, like 5 days in a row. And it looked like it was going to break out, but there was somebody huge selling there. Lo and behold, Bezos wanted a new sports team, so he kept unloading every single time price was over 200. And that excessive selling pressure just was overpowering for the buyers, and the buyers could not contest. And eventually, we had a significant pullback from that 200 handle. So that's just the why behind it, right? Because anybody can say, oh, well, a support is where the price bounces. Yeah, but why does it bounce? So that's the why. And now let's get into how we can identify these. So the first thing is you want to look for significant previous lows when identifying supports, not just like minor little dips or minor pullbacks. You really want to be focused on the daily, the monthly, the weekly charts, these higher time frames, because these levels are much more significant. Another thing is you want to see multiple touches without breaking. If a support is real, it can be tested multiple times and it will hold. Just like we just talked about the Amazon getting tested multiple times to the upside, but holding. We knew that seller was legit and that he had strength. So if the buyer is legit below, he will keep reloading off of his entry, and he'll keep saying, hey, I'm holding this thing up and I think it's going a lot higher. And once the sellers exhaust themselves into me, we have clear skies ahead. So another thing, round numbers. I know it sounds simple, but sometimes the market is very simple. You know, those Wall Street boys, they love trading off of meme levels, for example. So the round numbers are obvious. You got 100, 50, 20, anything divisible by 10 in general is going to be responsive to price action. And the more substantial that division is, the bigger, or, the more important it is. So 100 is a very, very notable level on any chart. It just is, There's very, very, very few examples of a chart that will run up into 100 and just surge right through, So you always want to keep an eye for these psychological levels. And I'll give you some inside baseball, some free alpha here. On SPY, it loves trading off the 10 handles. On Qs, it loves trading off the 666 handles. I do not know why. I'm not saying it's some demonic conspiracy, but I do know that over the years of watching NQ, which is NASDAQ futures, it really loves forming pivots at 666 and also 333, a division of 6. So just throwing that out there. If you're trading some meme stuff like Bitcoin or Tesla, I know it sounds immature, but those 69 handles and those 420 handles, they really do matter. I sold all of my MicroStrategy into 420 and it turned out being the top, right? So I won't question why. Maybe finance bros just have a little bit of an immature sense of humor. I'm not sure, but it's important to remember that not every low becomes support. So you got to look for that respect in the price. You got to look for price to respect those levels. Let's see, just checking in on chat here. Okay, DJ2AM saying, just curious, how would somebody know that why with the Amazon story? Just keeping up with the news? Did you get the heads up on a mainstream or in a community? So we were all trying to figure it out. I was long Amazon and I was not happy. I was like, what's stopping it? What's stopping it? And then about 3 or 4 days later, a headline broke that Bezos wanted to buy some sports team. I forget what. So he was quite literally just funding that with big sells. Another thing you can do is look out for insider selling. I think that, it depends on when they report it, but in general, they do have to report in a relatively timely fashion. So if you're seeing big insider sells, it's obviously a sign that, oh, okay, we're probably approaching or into a major resistance. So great question, because it's weird, right? It can be very, we're playing Clue here when we're playing in the market and we're trying to figure out why things are happening. And it's not always very clear. And, there's also a lot of smoke and mirrors and obfuscation that big players use to kind of hide their intentions. So maybe when they're building a position, they'll use off exchange dark pool prints. They'll go make a deal with somebody off the exchange at a certain price, and then it won't be reflected in the chart immediately, but they'll basically be able to hide their hand. So there's a lot of stuff like that going on both sides of the tape. And again, you'll drive yourself crazy trying to analyze every single fundamental headline. It's so much easier to consult the chart. So I didn't need to know that Bezos was selling because, I knew somebody was selling. I knew that there was something that was like a brick wall at that 200 level. So that's kind of how I would frame it. That's crazy that they can do that. Yeah. The more you learn about the methods that investors and businesses use to influence stock price, the more jaded you get. There's a lot of laws that probably should be passed for the benefit of people. But hey, this isn't a political stream. This is a technical stream. So we're going to just figure out how to use these to our advantage. And maybe someday you and me, DJ2M, we can save the world. But for now, dark pools are a thing, all of that, so we gotta play the game that we're in, right? All right, moving on here. Let's do the same thing for resistance. It's basically the same thing. It's a mirror structure, right? So just like identifying supports, we can flip that and use the same logic and reasoning to identify resistances. So just really quickly to overview that, significant previous highs, major peaks only are going to act as very responsive levels. And let's talk about the why there. So why is there going to be selling into or slightly over a previous high? So essentially what we're seeing is, say you were, let's use this chart at the bottom here as an example. So say you got long on this pink candle right here, this top wick, and then it rejected. And all of a sudden, okay, you're in one day and you're already in the hole. You don't want to sell yet. You want to give it a chance. It just keeps going down, right? So then this day you get a gap up and all of a sudden you bought here, you're green. So there's a strong incentive for anybody who was long up in here and got pulled underwater down here to sell once they're green again and wait for things to provide more clarity. So you'll always get sell pressure over recent peaks, sometimes before recent peaks. It depends on where the volume is located primarily, and also, other factors like the velocity of the move up, maybe the short interest, if there's potential for the bulls to really take the reins and squeeze it higher than that. And then you can look to clear out stops of people who also got short in here and they're doing great, but then they got gapped up and they have to cover at break even. So between those two factors, you'll get really responsive price action into these major levels. So it's always important to chart those out on your charts. Get the top of like the wick for sure, but also keep an eye on the body high, because remember, the bodies of a candle represent institutional investment. That's where the big money comes in, on these hourly flips, on these daily flips, where these pivots form on the actual bodies of the candle. The wicks, you can kind of look at that as exuberance or fear in like retail trading, kind of running things up or pushing things down more than they probably deserve to be pushed around. So I do chart wicks, but I do not give them as much validity as I do to levels of body closes, candle body closes. So we talked about the why of the response at previous highs. Round numbers, we talked a little bit about that. I mean, the psychology behind it is just it's purely psychological for the most part. Round number, we like that. We want to buy something at 50 and sell it at 100. It's just in our genes. I'm not qualified to explain why that is, but I know it's true because I sure feel it. I like buying at one number that's nice and even, and I like selling at one number that's nice and even. It's very clean, right? So another thing is volume spikes at key levels. So these volume spikes show heavy sell pressure. And you just always want to keep an eye on these volume spikes and what price does. So if you listen to a few of my webinars, you know how I feel about volume and price confluence. You want to see big volume aligned with big price movement. If you see big volume and no forward progress, and maybe a big top wick and maybe a start of a reversal, that's a big sign that a local top is in, and that you've encountered heavy selling pressure. So these are some things to consider for resistance levels. And yeah, just remember where prices failed before, it often fails again. Just how it works. So next up is the role reversal concept. So I got a little quote for you. When support breaks, it often becomes resistance. When resistance breaks, it often becomes support. I know that's super profound, right? Well, it's simple, but it really does matter, because essentially the psychology behind it is that traders remember where they got hurt and they react to that same price. We also have the factors that we talked about before with, anybody who was caught there, all of a sudden they get an out. We call that a mitigation block or a mitigation move, where it mitigates the move down and gives people a clean exit. And a lot of them will take that exit, So that's why the concept of role reversal is really important. The other thing is the opportunity. It essentially, this is one of the best ways to get a really high risk to reward opportunity. These role reversals create some really high probability setups when they present themselves, and you can start to really snipe things off of, for example, dips down to high volume, high liquidity nodes where there's a high possibility of a reversal. And you can get a really clean entry for a long up to the next kind of pivot point, as we call them. So here's the kind of process. Here's how this works. So you get the break, and then you get the retest, and that confirms that the role is flipped. And once it's flipped, then you get a really nice trade opportunity there. So we're always looking for these levels, these supports to flip to resistance, and for these resistances to flip to supports. Welcome, Beach Bum Trading. Happy Friday. Hope you guys had a great trading day. It was a wild one there. Welcome on in. So we are talking about all sorts of stuff regarding technical analysis and how to build it into our system. And next up is volume confirmation. So we're talking high volume at support. So big buyers stepping in means the level is very likely to hold. Basically, the buyers are saying, hey, I'm waiting for my shot. And they're looking at this big level. We're all looking at the same charts. We're all looking at the same levels. It's all about how we play them, right? So big buyers, they don't like to overpay. They like to wait for price to come to them. And when they do step in, often that will provide a significant trend change, because they will essentially be buying up all of the stock at a certain level and accumulating it. And eventually the stock will simply run out. The supply or the demand will outpace the supply. And once that happens, the buyers will start bidding each other up, and the shorts will start having to close, and they'll be fighting over each other to close out their positions. And so the tandem effect of both of those cohorts of traders will both push the price up off of that big support level. So high volume at support without big candle knifing through it. If you have high volume, but no big, doom candle, then very likely you're seeing a support being formed and price being absorbed at that level. The same thing applies for high volume at resistance. heavy selling there, just like the Amazon example. Big Daddy Bezos was just sitting there, just hammering me every single time we tried to get traction over 200, and it felt terrible. But in retrospect, it was a really, really, really perfect example of this concept, right? Yo, welcome, welcome. What's up, Tack? Good to see you in here. All right, the gang's all here. We're ready to go. We're talking volume confirmation here. So low volume breaks are often false breaks. So just like that high volume means a lot more, if we get a low volume break, it can often be just like a little fluctuation. Maybe buyers are just waiting for price to settle and they want maybe an even bigger discount under their level. And you're not seeing the big volume. And so these false breaks, they often will reverse and form big wicks. And you know how bullish a big bottom wick is, right? Because price tried to go down, tried to continue past the level, and then it came back up pretty fast, within the body of one candle, whatever time frame you're looking at, and essentially closed back over the break point, that pivot point, that support level. And so, I personally love these failed breakdown setups. I think they're incredibly high probability. You have nice built-in risk management with the wick that came down there. It should not breach below that once it's reclaimed its neckline. So this is a setup that you can look for every single day. You'll find it more days than not, at least a few times a week on the indices. And, if you are rotating through different sectors and everything else, you'll find these constantly. So this is an excellent setup to add to your toolkit, these fake breakdowns, and you look for these low volume breaks and you expect them to reverse. We're not chasing down in the wick. We want to wait and see it confirm, but this is what you should have on your radar so you're ready to pull the trigger when it reclaims that key support. And the last thing is just focus on high liquidity trading windows for these, because when you're in a high liquidity trading window, just the moves will be more responsive and you can trust them more. And that's just because there are more shares being traded. It's a more accurate reflection of the price action when you have more people trading it. It's pretty simple. And just the flip side of this is a very small cap stop, like a micro cap, which can get yanked around by a few big players very easily. And so that doesn't really represent the fundamentals or even the technicals, because it's just at the whim of these large forces. When you're trading the high liquidity times, like the open of SPY, no one person is going to shove that down unless you're Buffett himself, right? So those are just some things to consider when you're looking for volume confirmation. I think these are super helpful and they take a long time to internalize, but they're pretty simple concepts. So I'm just going to keep beating you over the head with them, and you'll start getting them and absorbing them, and then you'll be trading me under the table in no time. Moving on here. Did I miss a slide? No. Okay. What are some common support and resistance mistakes that we encounter? The first, I think, is really important. It's using every single high or low on the chart. I think it's really easy to say, hey, this is a swing high, this is a swing low, I'm going to trade off of this. And then you realize, oh, it was a swing high on a 10-minute chart, and there was a much more important level, waiting off for me up here. And that was the real draw, or, vice versa. So it's important to, like I said, use the daily, weekly, and monthly charts, especially for these highs and lows. You can go down to the hourly. Under that, you're starting to get into areas of, less validity, less relevance. So just keep that in mind. The other big thing, and I know broken record here, but ignoring the volume. Volume is absolutely so key for any aspect of just about any trading system. So if you treat all levels as equal, it's very dangerous. You want to treat the levels with high volume using our handy dandy volume profile that we have a webinar on if you want to check more about that out. But using that volume profile, we can see the exact level that price came in, and that can give us a very intuitive reflection of which levels are more valid than others. The next thing is super important, and that's not waiting for that roll reversal confirmation. So you're not waiting for the support to prove itself as support. Maybe you're just buying the second it taps into it, and that's all well and good if it responds. At levels without waiting for that is a great way to get chopped up and chopped out of trades and potentially just become a straight bag holder. If something really big hits the tape in terms of news, you could be buying at this level that was holding, but now the fundamentals have changed. Now you're bag holding, it goes through that level, and now it's flipped to resistance. So it's really important really important. You gotta think about these things whenever you're taking a trade for sure. Now that we've talked about support and resistance a little bit, oh, the chart is frozen. Let me refresh and see if I can get that back. I'm sorry. Hopefully that was not a problem for long. I'm seeing it back here. Kathy or anybody else, if you could just give me a little feedback if this is coming through for you. I will take just a second here and let me know. But yeah, Tuck, how about that coin? How about that coin? That was did we talk about it last week? I forget. I know I'm in it. I know I'm in it from that 244 handle. And yeah, it's been popping like it's hot. I think that it is going to double this year. I'm going to be a big buyer on any pullbacks. I think we probably have a pullback coming just because we've had such an explosive breakout there. It would like to back test. Okay, we're talking about it 2 days ago. Very nice. Yeah, maybe we'll have a chance to go look over that chart because we'll talk about a support hold and a resistance smash there. You know, that was a roll reversal for sure. So thank you. I will take my flowers on that. It's been a very good trade so far. Anyways, moving on here. DJ2M says we're good. Kathy says we're okay now. Excellent. Okay, and it just popped off my screen again, so I'm going to reload it once more. And if it becomes a problem, I'm going to keep an eye on the chat there. Not sure why that is, but we're going to cook here. All right, great. So common support and resistance mistakes, using every high and low. We talked about that, ignoring volume. Oh, we talked about all this, but just to go over it in case you missed it, those are the three big ones. You want to be discerning with the highs and lows you use. You want to be discerning with waiting for volume to confirm. And you really got to show price or have price action confirm that volume confirmation as well. So the confluence there is what informs a good trade. Moving on to trend lines here. I think that, remember, it's important to note that they are not as steadfast. They're not as strong as horizontal levels of support and resistance, just due to their nature. They move every single day. The level that they're interacting with moves every single day, and they're very prone to interpretation much more than a support or resistance level, which is just associated with a dollar figure, right? So because of that, I think they're important, but you've got to give them a little bit more of a grain of salt when you're using them to trade off of. Trend lines in general will show both direction and strength of price movement. And, let's talk really quickly about uptrend and downtrend definitions. So an uptrend is simply created when you connect a series of higher lows, and that shows buying strength. And often it'll form in a channel, right? You can connect the trend line on the bottom too, and you'll get a nice range of which we're kind of trading and bouncing from the highs to the lows. People are reaccumulating at the lows. They're selling at the highs because it's running into that trend line. And it kind of gives you, it's kind of like bumper rails on a bowling alley. Like often the price will kind of bounce between the two and kind of keep you in the general trajectory of a stock. And the same thing for downtrends. So then you're connecting a series of lower highs, and that'll show the selling pressure over time, where each time buyers step in, they're not able to make a new high. Each time sellers step in, they're able to make a new low. So because of that, just remember that the trend is your friend until it bends. So respect the direction. And then if you get those roll reversal confirmations where a uptrend or a downtrend line flips on volume, then you can start playing the reversal game, and you can start getting some really nice entries on some really powerful moves out of some really deep bases often. So that's kind of the overview of trend lines. Getting a little bit more in depth, we can talk about how to draw them. So the most important thing is you got to connect at least 2 significant swing points, ideally more, right? Ideally more. So hey, just using this little placeholder at the bottom here, say we draw a trend line from the top here down, it bounces off the body here. Maybe this wick is a little false start over it, but then we get a nice 4 touches or so. And I'll pull up some more charts at the end. We can get some better examples. But then it's very clear that this is a break of this downtrend line, no matter if you draw it from the body here or just from the top to this wick here and down. So that is a nice confirmation of a push above and a flip of that trend line. So it's important to have multiple touches. Really 3+ is ideal. A 2-touch trend line, I give barely any credit to, because it's just, there's not enough data points for it to be that important, that meaningful. Always draw left to right, just because that's the progression of time. You follow the price flow, and that's what creates a valid line. And yeah, so they're pretty simple. This is not rocket science. But yeah, it's just good to know. Good to know for sure. And kind of integrate it into your support and resistance trading. So you have your horizontal levels, like this big pivot here, this one here, and then you're seeing price break through this downtrend line as well as these horizontal levels. And so you're building up a confluence of bullish factors for the move up. And I forget exactly when this was, but I do remember this chart broke out. So for what it's worth. Moving on, let's talk about how to trade these. All right, so how do we trade trend line bounces? The setup is essentially price approaches a trend line and then it bounces higher in an uptrend or lower in a downtrend. So we have the trend line, price is coming up into it, and our entry is essentially waiting for the bounce to confirm. So we're not going to front run this because remember, we're in a wide channel and essentially we don't need to catch the very, very tip of the move because there could always be a chance that we get that role reversal that we talked about, that powering through a trend line and then it back tests and holds as support. We never get a chance to get out of break even, and we cry while we get dragged. I think we've all been there, but but we can avoid it going forward. So how we avoid that is we try to manage our egos. We don't assume that we know what's going to happen. We wait for the chart to confirm what's going to happen, and then maybe that means we miss a few percents on the trade. But the trades we take are going to be so much higher confluence and so much cleaner of the move. So I think it's really important to just take your time and wait for things to develop properly, and you'll get real results in the gains. So the entry trigger is waiting for that actual bounce. Like I said, we're not anticipating. And then the volume confirmation is how we start to build a confluence of factors that tell us that this confirmation is real. So increased volume on the bounce, it shows conviction, right? If we have higher volume, it means more people are stepping in, and it's just more likely to play out. So the stop loss rule is place a stop just below the downtrend or the trend line, if it's an uptrend, and above if it's a downtrend, right? So essentially outside of the extremes where you're expecting it to bounce and not test that stop. So you want to just protect yourself because again, if something happens and we do get that role reversal, we don't want to get dragged into a whole new price expansion range, because usually that's what'll happen. If a significant uptrend or downtrend line breaks that with force, then often we kind of are out of that previous price bracket, and then we start to form a new price bracket, a new price range. So you could be very underwater pretty quickly, and that's why it's really important. CRCL, for example, if you are banking on that flag to fail and you did not respect the risk or the role reversal, you are currently sitting like 45% underwater in 2 days. So that's the kind of risk you run if you don't respect these major levels when they do flip. So that's our I cannot talk. I need more water. Stop loss rule. There we go. Okay, much better. Stop loss rule. I got it. All right. Profit target is really important too. So the previous swing high or low of this trend line. So remember, we're going to have kind of stair stepping down price action. So the previous swing high is really important because that's the first step where after we kind of confirm that that's a likely bottom, that's the first step where sellers could step back in and try to push us back down. And remember the why, right? So we have that previous swing high. If people were long on the way down from that previous swing high, well, price came back up to them and now they have a chance to get out scot-free. So a lot of traders are always going to take that. A lot of traders are going to be sitting there going, hey, in the past 2 weeks, things have changed. I think there's a better way for me to allocate my capital. So because of that, we're just looking for the same reactions that we talked about on the support and resistance slides at these levels. And then just the last thing is, remember, patience is super key with these. It's so much better to miss the first part of a move than it is to catch a false bounce and just get dragged. So that is how I would look at trading trend lines. And a few more things. I think I have a duplicate slide in here. I think we've talked about this stuff. I'm gonna move right along there. So let's talk about some essential chart patterns really quickly. I'm going to keep this relatively brief because I think that it's more important to get to chart examples that you guys want to talk about or answer questions that you have. And I always go long on these things. I always want to talk more. I think I just love hearing my own voice. So let's briefly go over rectangle patterns here. Super simple. You've got the big resistance, flat top resistance, and big flat top support. So the chart we're looking at right now is Chipotle, CMG. And this is from today. So this is today's price action here. I think maybe it's an hourly candle chart, maybe a 4-hour, something like that. But oh, Talk, you're distracting me. I want to talk about this. Let me get through this slide, then I'll come back to that. So essentially, Chipotle here is showing a really nice sideways rectangular consolidation. So remember, I want to talk about the why behind these patterns. I think anybody can say, hey, look, that's a rectangle. But what does it mean when we get a rectangle? Essentially, it means that we are stuck in a range. There is a big seller sitting up here, sitting up here, sitting up here, got overrun a little bit, but stepped right back in, right? And then there's a big buyer down here. Every time it comes anywhere near this level, they are buying it up and they're trading it to the top of this range. So it's a very established range, and it basically shows over time consolidation. So Chipotle had a crazy parabolic move up. It had a steep move down, and then it started doing the sideways basing action. And essentially what we're seeing is either accumulation or potentially distribution for a continued move down. But I think there's some hints that kind of show us that this is probably accumulation. So accumulation, what you're looking for is higher green volume than red. And I mean, we don't even have the volume bar on here, but we can still see that these candles, these green candles are really, really kind of big and explosive. And often we get the one big move up, and then it takes 5 candles for it to trade back down. Big move up, that was a big red candle, but then another big green, and it's overall on the bottom, it looks like to me there are more bottom wicks and kind of showing accumulation over time. But essentially what we're seeing is range trading, and we just had a move down. We are more likely to have a move up if we are showing significant accumulation, which is generally what rectangles show. So it's a pretty standard pattern. It's often just considered a base. You can just say it's basing, it's doing the rectangle, whatever. But it's something you look for because often this is the price action that you'll see on reversals. You can sometimes see this sideways action after a big move down and then a continuation move even further down. More often than not, though, it will not be so prolonged like this. So the longer the base, the bigger the space. The longer the base, the more there's price accumulation going on. And now really quick, I do want to just mention, just because you're talking about it, Tuck says coin over circle is insane. Not sure how much, if any, received from CRCL. So essentially, just because I am in this trade, I have a little bit of insight here. Coin has, okay, one of them is massively mispriced. Circle has run way too much probably, but it's an IPO. It's just moving mechanically and getting squeezed. And these kind of IPO crazy rippers, they're kind of a sign in a way of financial nihilism. Like it's traders rejecting the tried and true. And they're saying, hey, I don't care what the valuation is. This thing's moving. I'm just going to hammer this thing. Coin, on the other hand, is much more established and I believe is vastly undervalued based on the deal with Circle, the whole stablecoin situation. And most importantly for me, the technical setup, because I didn't know anything about them and their Circle deal until this week. And it wasn't why I got into the trade. It was just, it came up as I was looking for potential reasons for why coin could have an explosive move, because I saw the explosive move setting up on the chart. And I was like, hey, I got to do some sleuthing, So this is the kind of gist of how I combine technicals with fundamentals. And I think it's a great example there. Also a free alpha, go buy some coin. Maybe not tomorrow because it's Saturday. Maybe not first thing Monday because I think the market could pull back a little bit. It's been a big move. But when we get a good, valid buy entry, I think it's a great name to have on your dip buy list for sure. So yeah, real quick, we can talk about this a little more and then we'll move on because I would get distracted and do a whole webinar on coin. Let's see. Oh, this is about XRP. I will not weigh in on that just because I don't know anything about XRP. I also see that, at least on my end, I'm not seeing my chart. So I'm going to pop that back on. Just making sure there. Let's see. Talk saying, as approvals and governance on stablecoins is realized, we will maybe even see a Solana ETF. Absolutely. And when we do, I'm probably going to be a buyer. And anytime an asset gets institutional inflows and is basically assessed by big money as something that is a stable, like an actual asset, like we saw with Bitcoin, it's just a massive, massive boon to them long term, because you'll have these passive income flows, these like pensions that are buying into this stuff like that. So absolutely. And especially if stable coins are pegged to USD, which heck, if they're not, I don't know what the heck they would be paired to. So if you look at, yeah, okay, you're really bringing a lot of stuff together, and I love it. If you look at MasterCard and Visa on Wednesday dropping, you just connected the dots for me. I didn't even think about that, but that's absolutely but why that would provide. That's completely logical why there would be downside pressure. So very cool, very cool. I'm looking forward to your webinar, hopefully soon. So yeah, the removal of payments, the middlemen like MasterCard and Visa, they're going to take the biggest hits because that's their primary source of revenue. Excellent points there. Awesome. So moving on, let's get on to the next chart pattern here. We have triangles. Gotta love triangles. You know, the old Illuminati triangle sign there. You know, when you see the triangle, you got to keep an eye out here. So this one here is an ascending triangle. I believe it's on Apple. This is a weekly chart. And what are we seeing? We are seeing a flat top base, roughly flat top. This overshot a little bit, but you know, life's not perfect. And then we see the uptrend line here. And again, I'm not seeing my chart on my window, so I'm going to pop it back on just to make sure. Apologies there. We have essentially a series of highs that cap out at the same place and lows, which keep getting bought earlier each time. See that? Each time price dips, buyers are more willing to buy at a higher price. So that shows accumulation. That shows that essentially shares down at these levels are drying up. They come back. They can't get down there. It comes up, breaks the high a little bit. That's always bullish. Comes back down. It cannot get down here because people are already buying higher. They are front running this. They're saying we are not in a rectangle. We are in a triangle. See the difference? So rectangles, they're more of a longer term accumulation pattern, and triangles are usually an extension pattern here. So Apple had already made a move up. It already confirmed that it was in a bullish trend. And now each of these higher lows confirms it. So there is the potential that you get exhaustion right here. Like we talked about with Amazon, it was also doing one of these patterns. But the difference was that seller in Bezos was much stronger than anybody else could be. In this one, the buyers were just building up steam, and then pushed higher and off to the races here. And this is like literally 70% lower. So, you know, the move had massive legs, obviously not a straight shot, but, you know, Apple didn't go down much in the past 15 years, 10 years. So ascending triangles, the hallmarks of them are these higher lows in the buildup. And again, you should be seeing higher volume on the green sticks when it catches than you are on the red sticks when it pushes down. And this is all just basically coiling a spring that eventually will pop. And you can trade it out the top like here if you're a breakout trader. I much prefer the back tests here. And as you can see, it gave a really, really nice look 3 weeks in a row where it whipped back into this before surging super strong. And by waiting for these back tests, you're essentially, you're not only increasing your win rate, but you're also increasing or decreasing the amount of time that your money's just sitting there doing nothing, chopping around. So remember, it's the same thing that we're talking about with any support or resistance. We power through and we wait for the roll reversal confirmation, which is on this back test when buyers step in and say, hey, we're not in this range anymore. Now we're expanding into a new range, and the high of the previous range is now the low of the new range. Hopefully that makes sense. Let me refuel the water here. All right, we did rectangles, we did triangles. What shape is next? Not circles, flags. So I thought this was one of the most important ones that I could bring up. I bet Talk recognizes this chart right here. So this is, spoiler, this is the daily chart of coin in the past couple weeks here. So what are we seeing here? What are we seeing when we see a flag? We saw price surge up. We saw price surge up on the S&P 500 inclusion. You know, so there's some catalyst. It breaks the previous range, and now it is going to consolidate before either continuing the move if it's got juice, or reversing the move if it was kind of a false break and the catalyst was not very important. Being included in the S&P 500, pretty important. their whole business with CRCL and CRCL exploding in value is a very, very, very tangible catalyst. So I would expect this move to continue. I would expect this breakout to be real. And you can just tell by the size of that stick. And if you look at the volume, I didn't have room on my chart here, unfortunately. But you will see that confirmation there too. So let's talk about the why of a flag. Why does a flag form? You get the big move up and then it needs to consolidate. Price always needs to consolidate and digest after a big move. And it can do that in two ways. It can do that via price by, surging up and then surging back down. And you'll see that a lot on higher shorted things or less appealing investments, things like in the IWM basket or biotech, stuff like that, small caps, where they don't really like to correct via time very much because they're just wild and whippy and volatile, and they'll just correct via price. So they go way up, they come way down, but maybe they hold a higher low, they go way up, they come way down again, hold a higher low, that kind of price action. The other option is you can correct via time. And what correcting via time looks like is a basing pattern. And so you are seeing undercuts happen consistently where the swing low here is undercut by this swing low here. So they're kind of clearing out stops. But then what happens? They do not flip. It's not a role reversal where it pops out the bottom of this and then when it back tests, it rejects. We're not seeing that. What we're just seeing is slight undercuts and basically shares trading hands from short-term traders to longer-term traders. And those longer-term traders, the ones that hold, those are going to be the ones that really sustain a move. So we look at this as just digestion primarily via time. Coin traded essentially flat for 3 weeks here, 2-3 weeks, 3-4 weeks, something like that. And each time it came a little bit lower, short-term traders got stopped out, but long-term traders were saying, hey, I'm all in. I love this. I just wanted a little bit of a deeper dip. I got it. And those long-term traders pop the price back up with their natural buying pressure. Then short-term traders say, okay, we're at the top of the flag. We're not ready to break out yet. There's no catalyst. Time to short this thing. And they are only really looking for an undercut of this to fill out this flag formation. And once they get it, they step back out, and those long-term buyers say, oh, thank you. Why don't I deserve seconds. I deserve thirds. I'll build a position here. I'll accumulate. And then they do, and price responds accordingly, right? So that's the flag type formation that we're looking at here. And that's the how and the why behind it. And then when you're seeing these candles like this and like this, where they are breaching a previous trend line, that is a really good indication that price is probably ready to start making a move into a new range. And as you can see, it happened really quick. What you can do is maybe you don't buy this just because it's peeking out there. Maybe that's not enough for you to buy. But what you can do is you can wait for a logical place where it would come back to and look to buy. So if anybody was following me in my coin trade, I was very much a buyer off of this 20 EMA. And I was really looking for any sign of a reversal under this 9 EMA on the daily. So because of that, I got an entry here. No. I got an entry here. And then I got knifed, and I said, okay, well, we still have this bottom of the flag formation. I'm still like the trade. It's holding where it needs to. This was 244, I believe. It undercut that. And then I added when it broke back above here at like 244, I believe. So my cost basis is 243-ish. So yeah, just a huge explosive move off of there. But these are kind of ways that you can trade a flag. So I hope that made some sense. And mostly I just wanted to brag about my coin trade. You know, us traders, massive egos, what can you do, right? But now we're going to look for the same thing. We got the pull. Now we're going to look for consolidation, a flag, correction via time. And then I'll be buying again when these moving averages catch up. Right now, overextended, I'm holding it, but that's where I'm at with coin and flag trading in general. So we talked about some patterns. Let's talk about how we can recognize when they fail. The reality is that patterns don't always work. They fail about 30 to 40% of the time. And that can sound daunting. That can sound bad, but just remember, hey, that's better than 50%. And we're managing our risk and our reward in a way that we don't need to do better than 50% to make money, because our wins are going to be bigger than our losses because we are respecting our stops and we are letting a position that's working keep working. So because of that, yeah, you don't have to look at the 30 to 40% failure rate as a thing that's bad. You just have to be ready in case it doesn't work. Pretty simple in that regard, at least. So, like with anything else, volume confirmation is key. If you don't have significant volume, that'll lead to the pattern failure. And another aspect is time decay. So patterns that take too long to play out, they often increase the likelihood of failure because people will get bored and maybe they'll find better, more appealing opportunities to put their money to work. Because of that, just keep in mind, there's lots of metrics you can look up in terms of like the rough, how long a trade takes to play out and or a pattern takes to break. And if a flag's supposed to break and it just keeps holding sideways, maybe that's a sign that it's just basing longer. But maybe there's somebody just sitting up there like Amazon, just bopping it down, and maybe eventually that'll kind of take precedence. So the last thing here is risk management. Just really important to always have an exit plan because things happen. Things happen, and the most important thing you need to do is protect yourself from tail risks. And a tail risk is a small likelihood or a low percentage likelihood event, which would lead to an outsized move. And when you get them and you are not protected by stops, let me tell you, it is not fun. It is not fun. I hate to throw my friend under the bus and use him as an example here, but he was betting against CRCL and he's about 40% underwater on his position right now in a couple days, and it's not fun. And I wish he had a stop, but it is what it is, I guess, as they say. So ideally, don't be like my friend there, and don't get dragged. Really quickly, I'm going to grab some water and then we'll hop right back into this. All right. Appreciate your patience. I appreciate you, DJ 2 a.m. Hit that like button if you feel like it. I won't beg, but I do very much appreciate it. So we are right back in things. Let's get into what we have up next. We have combining these support and resistance factors with trend lines. So pulling these concepts together, we get that high confluence that we're looking for in trade. So that's the first thing. Remember the power of confluence. When you have multiple concepts aligning, the probability increases dramatically. So what we're doing is we're saying, okay, maybe the pattern only has a 60% hit rate, but when you add in support, high support, you add in the nice volume confirmation when it tests it, you add in a downtrend line break, all of a sudden you're bumping that up from maybe a 60 to maybe more of a 70, 80, 90%. I don't know. Nobody knows, but you do know that it increases your odds dramatically. So because of that, that's always what we're looking to do, build a layered approach. So building that analysis layer by layer is how you get the complete picture. Then you're not honing in on one factor and getting hung up on, well, I have this level, I have this line, it responded to this line once, it's got to do it again. And you don't realize it, but you build up these subconscious biases, which maybe don't reflect reality. So how you check those is you keep checking in with other factors and you build them together. So for me, I don't take a trade if it's only one indicator telling me, or one line on my chart saying that it should do something there. It's got to be a holistic approach, and that'll really, really juice your win rates there. So people are like, inverse head and shoulders only have a 60% hit rate. It's like, well, mine don't, because I only take the ones that have multiple confluences, So not saying I'm a god or anything. I'm just saying that you don't have to be a god if you come prepared and you build these things together. And then, like I always say, it's not about being the smartest. It's just about being methodical and systematic, and really respecting that, we all have an ego. You got to have an ego to trade, but you got to respect that you're not always going to be right. And, by combining those, you'll get a lot higher of a percentage than any one statistic might reflect. So another thing that I think is really useful is assigning a strength rating to setups. So, when you're going through as many charts as I am, it's so easy to say, oh, these all look bullish, I'll buy a little bit of all of them, but it's usually better to kind of rank them by strength and by number of confluential factors. And by doing that, you'll help kind of sort the wheat from the chaff, and you'll only be focused on the top setups. And so then, again, you're just bumping up that percentage rate, that hit rate. Oh God, you're going to get to my head. No, I'm absolutely not the best trader, even in this room. I guarantee you. I just, my edge is technical analysis, some, but mostly education and explanation. That's what I'm good at. So I'm a better explainer than I am a trader. And often I will make mistakes that I talk about. I'm by no means perfect by any stretch of the imagination, but I appreciate you. And thank you, Kathy. Thank you, Duke. I appreciate you guys very much. Let's see. So yeah, the best traders, they wait for that confluence. The multiple confirmations are where the real money lies. Now I want to get into the hard part, the fun part, the homework part. So this is where you guys are going to have to put in some work. You'll see the system, but then you're going to have to put it into practice. So let's talk about the little checklist I put together for you guys here. First off, just remember, it's the same process, every chart, every time. What we're doing is all about replicability. Think that's the way to say that. We're going to go with replicability. So the purpose for this is eliminating guesswork. And if you have a systematic approach, you also will separate yourself from the emotion of any given trade. You won't be getting caught up in your biases as much, because it'll either fit the criteria, or if it doesn't, or it doesn't. If it doesn't, you don't take the trade. If it does and it doesn't work, well, that's just the way she goes, right? It's just bound to happen in those 30 to 40% of setups, right? So because of that, it really helps you be unemotional. And I always talk about Michael Noss, our partner here at Trade the Pool. You can catch him on stream every morning, and he is a robot in the best way possible. He has a system, he sticks to it, and he came in third, I believe, in the big one for all challenge we just had, that event. So, talk about an example in real time. So if we're gonna assign the God label, it's Michael, because he is a robot and he will just hammer his setups and he will just make that consistent money every single day. He has new setups based on his criteria. Every single day he makes consistent profits, and that's what we're all here to do, right? So the first step in achieving this is identify major support and major resistance levels. You're going to take your chart. You're going to look for those major swing highs, major swing lows. You're going to look at your volume profile and see where that volume is coming in, and you're going to mark those out. Next, you're going to identify any relevant trend lines. If present, there won't always be, but sometimes you'll get a really defined 3, 4, 5 tap trend line. If it's 1 or 2, don't even bother. If it's 2 or 3, maybe it's worth your time, maybe not, but assign it less weight. But if it's 3+, then you have a valid line here, and you're going to start looking for breaks on volume of those lines. The third part, we're going to work in the chart patterns that we talked about. We're going to look for those patterns and formations, and we are going to help kind of combine all of those together to give a valid setup. The fourth step, I think this one's really important. We didn't talk about it a ton, but it is very important. You got to check the higher time frames for confirmation. So it can't just look good on your 1 minute chart on your, I always give Tim a hard time, his 30-second Heiken Ashi charts, no. Obviously totally valid to be a short-term scalper, but then you're referring to the short-term charts and you still have to pay respect to these higher time frame levels, because a higher time frame level gets tested much more, and therefore it has more validity to the level. That's a part that was really missing for me, because everybody always told me higher time frames more important. And for a while, I didn't really understand why, but it makes so much sense if you think about it. On a higher time frame, like a weekly pivot, those levels are getting traded so many more shares are getting traded at those levels than a pivot on an intraday chart. And so because of that, there's a lot more price memory. There's a lot more of a, cohort of the market which is trading at that given level. So VSync Tim over here, press F to pay respects. Yeah, absolutely. And DJ 2 a.m., he was listening last week. Hope is not a strategy. Absolutely. Hope is not a strategy. Hope is a feeling. And, feelings are great. Feelings are great for your personal life, but they're not always great for your trading life. So let's keep it analytical. Let's keep it where we know that there's data to back up our decisions. So step 5, I'm kind of cheating. It's mostly 4 steps, but we're combining all of these signals and we're confirming them with volume analysis. It's kind of cheating because volume analysis comes in with all of these other things, right? A support level or a trend line is only valid if it has the volume to support that move. Same thing with the higher time frames. Why the higher time frames matter is because there's more volume, right? So when you confirm all of these with volume, it really helps you kind of have that conviction in a setup. And just because you have conviction doesn't mean you don't respect your stops, but it does mean that you're feeling more willing to take the risk, to take that jump and enter the setup. So this is your checklist. What's our timestamp here? 1 hour and 12 minutes in. This is where you want to go if you want to touch base on this, recheck in on this. And then what I'd love to see is you guys use this and next week come back to me or talk to me in the Discord about if you're able to do this and to put it into some action there. So really quickly, before we get into your specific homework assignment, I just want to talk about some common chart reading errors. We kind of went over this a little. I want to just double down on it here. So the first thing is seeing patterns that aren't really there. So this is wishful thinking. This is hope, as DJ 2am would say. And what it is essentially, our brains are wired to see patterns. Literally, you look around. I don't know about you. I'm in the beautiful, I'm in Glacier National Park right now. Nature's beautiful, but I'm driving along. I'm looking at mountain ranges and I'm like, oh, that's a higher low. I'm like, oh, that's a trend line break. We love to see patterns. It's what we do as human beings. So because of that, yeah, VSync saying, I'm so bad at pronouncing this. Pareidolia, something like that. Essentially, we see faces in trees. We see, shapes in the clouds. It's just what we do. We are pattern seeking creatures, and that is a big part of our higher intelligence. We are able to see something and extrapolate forward. It's a superpower. It really is. But just like some evolutionary benefactors or, evolutionary features, which are good for us overall, so they can sometimes impact us negatively in the short term. Like we are all probably a little more stressed out than would be better, than would be best, just because, well, we got to this point by looking over our shoulder for the saber-toothed tiger, running after us, So some paranoia is good. It's how we got here. But we also have to use our higher functioning to temper those urges. In the same way, we got to temper the urges to think that everything is a pattern and everything needs to be traded. Oh, goodness. Tim making the executive decision to scare the crap out of me with that pop-up there. But yeah, absolutely. That's a great example of pareidolia, whatever the heck. Oh, good to see you here, David. Just popping in for a minute to say keep it up. Created an options market today with CRCL. Okay, interesting. Off to San Diego International Boat Show. Okay, David, it's great to see you. Thanks for checking in, and I hope you have a great time down there. San Diego is absolutely beautiful. Awesome. Oh man, I love this. We got a community building. I'm seeing new faces coming in, but I'm seeing the same faces coming back, and that makes me happy. I love that. Yeah, Tim saying that jump scare there was the face on Mars. And yeah, I would be terrified if I was looking around the moon and around in space on my telescope and I saw that. Okay, yeah. Tim, after this, you'll have to teach me how to pronounce the darn thing, but very cool. So yeah, seeing patterns that aren't there, don't want that. Ignoring the higher time frame context. Like I said, those are where the real volume comes in. Those are what really matters. Keep an eye on those and don't get too caught off guard or, caught flat-footed just by focusing on an intraday chart. Number 3 is overanalyzing and creating paralysis. We just have a tendency to like to analyze everything, but that's why I like this 5-step checklist I gave you, because it hits all of the essentials and you won't spend too much time in the weeds, just kind of sifting through things that maybe aren't as relevant on that percentage gain that we're looking for, right? We're looking to take that 50 to 60, 60 to 70% win rate and just bump it up with confluences. Some things don't serve that and you can just leave them to the side. The other thing here is, bad production value here. 11323. Apologies there. This is number 4, and it is trading every level or pattern you identify. You just don't have to do it. There's just going to be so many out there, and that's why we rank them 1 to 5 or whatever your scale is. So we only are trading the best of the best because there is an abundance of opportunities. I'm teaching you guys how to fish here. There's always more fish in the sea. So go after those big juicy tunas, So next up is not waiting for proper confirmation. I will spare you guys. I've probably said it 10 times already. You know what I'm going to say. Just wait for the confirmation. Discipline beats cleverness in chart reading. And Tim, another shout out here. We always talk about kick flipping the rake, right? There's a comic where one guy's walking by, he steps on the rake, comes up, smacks him in the face, like a Tom and Jerry cartoon. The next guy, he takes a running start. He lands perfectly on the rake. He grinds down a rail. He hits a nice kick flip midair. Then he lands and he still ends up hitting him in the face, right? So you can get really fancy with it, and sometimes it just hurts you more in the end. So you don't need to get too fancy. We know the basics. We know the fundamentals. Let's hammer those fundamentals and start compounding off of those. All right. Integration with our trading plan. We talked about building the trading plan last week. We talked about things like entries and volume confirmation, the setups and the stop losses, but we didn't really get into the details. So I just wanted to get a little bit more, get in there with a fine tooth comb and just talk about that a little bit more. So for the setup, when price looks like, okay, I think this was supposed to go after the trend line one. So it might be specific to trend lines, but we'll extrapolate there. So for the setup, for example, with the trend lines, when the price approaches the trend line and bounces, then that's the setup. Then the entry trigger is waiting for the actual confirmation of that bounce. We aren't anticipating. Then we look for the volume confirmation, that increased volume on the bounce. That adds to our confluence. It adds to our conviction. We have our stop loss just on the outside of that move. So whether it is coming up into a trend line, then we put our stop loss above that. We wouldn't expect it to go above. And if we're, buying a mean reversion move down below, we put it on the bottom underneath that swing low. That'll keep us safe. And remember, if it flips, it can flip hard. So you got to respect these. And I know it sucks taking stop outs, but it sucks a whole lot more to be down 50% in a couple of days. And that can happen too on these. So just always keep that in mind. Next thing is the profit target. We always look for those swing highs or swing lows. I'm realizing as I said this, that I've given you all this information previously. So pardon me, bear with me there. And we're going to move on next to the next one here, to the homework assignment. So we are going to, as a group, you're going to do it alone, but then we're going to come together. We're going to talk about it. I want you guys to analyze 10 different charts using those 5 steps. I don't want to overwhelm you. 10 shouldn't be that bad. It should take you maybe an hour tops. If you're serious about this, I think it's a really good use of your time. And I think it'd be really great if you took some screenshots. You can share them in the Discord trading room. We can talk about them together and see what we all see together. And what I think would be really good if you're up to the talent challenge is submit your top 3 into the server. And then we can go over those really in depth. And this is just a practice in, picking the best of the best, in scanning through things and taking all the things we've learned and combining it into one system here. So that is your homework. That's your assignment if you choose to accept it. I hope you do. Let's get into some key takeaways here real quick. This is the wrong slide. I apologize. Okay, we're going to do it live here. Key takeaways. Key takeaways. Wait for the confirmation. Volume will lead the way. Build up those confluences. We want to build the confluences together with all of these different factors. So it's not just one thing. It's not just support and resistance. It's not just trend lines. It's not even just volume, even though that's a big one for me. It's about using these and stacking these in your favor to, to just get every little last ounce of positive alpha of factors in your favor that you can there. These are definitely the most important things I want to hit on. I could talk to you about, the details of any of the one things that we talked about, but the gist of it is that you need to bring them together. And that's what this whole series is about, building a whole system of confluence to help systematize your trading. And so we're not all over the place. So that's what I got for you today, guys. I hope you liked it. I hope you learned a little bit of something here. Now I would love to take some questions here. So if anybody has any questions on what we talked about, that would be great. And then we can also move on to questions on anything else. You got me for a little bit longer here. I know these always go over. I think I'm supposed to stay on for an hour, but here we are, an hour 20, and I want to keep going. So you guys, any questions, feel free to pile on in. DJ2AM says, we'll be joining in a second. Thank you, dude. I appreciate you being here. All right. And I'm going to just start hopping in here. So let me move my windows around so I can see these questions better. All right. Dan R, welcome. You're new here. Welcome. Okay. You're swing trading options and you analyze the chart using a 4-hour to weekly time frame. But what time frame should be my entry point? 1 hour? Great question. So this is pretty personalized. It depends on your trading style. So Dan, are you trading like weeklies? Are you trading options 3 months out, 90 DTEs? Because that'll definitely depend. I would assume if you're using a 4-hour in a weekly chart, you're probably not using you're not trading weeklies, which is good. I would recommend not doing that. But in general, I think that the analysis on the higher time frames is excellent. I would go in to an hourly chart at least, and then you can kind of keep honing it down, right? So you can look for levels of interest on the hourly chart. And then when you start to enter these points of interest, you can flip to a 10-minute, a 15-minute. I love those two time frames. I usually go 10. And what I'll do there is I'll kind of pinpoint my swing entries. And I won't say more often than not, but quite often it ends up being a very, like a snipe entry, like where you really catch just the bottom wick on an hourly candle, for example, or, and that obviously progresses to the bottom wick on a 4-hourly and a daily and sometimes a weekly candle. So by kind of using the system that we talked about, and I know you might have missed that, but this will all be recorded. I highly recommend you, check it out if this sounds interesting to you. So essentially, you can hone in from the high time frame to the low time frame, and you can use these factors to kind of pinpoint your entries. I would use a hourly at the least, but probably zoom in a little bit more to a 15-minute or a 10-minute chart there to really snipe it. All right, thank you for your question, and yeah, feel free to give me more information. Oh, there's the rake. There's the trade. Yeah, this is my life. This is my life. I think I'm experienced, and then I end up just kick flipping the rake, as we say. I love it, Tim, with the extra high production value. I love it. All right. So let's move on back here and see what I missed. Talk saying, LOL, that's why every measurement turns into a Fibonacci sequence. Tim starred this one for me. I feel like that's a personal attack because I do this. I definitely do this. I'm like, everything is a Fibonacci level if you find the right swing. So yeah, I'm assuming we were talking about how you can see patterns and everything when we were talking about this. And yeah, essentially, you got to be discerning. You can't just slap a fib on any old thing. You got to really make sure that it's a valid swing high and a valid swing low, and that'll give you a valid range with valid Fibonacci levels. Otherwise, you're just having fun with it, and that's fine too. But we're all about the high probability stuff. So what else we got? Bill R saying direction of SPY. Is that a good filter? I'm not sure exactly what you mean, but I think I got the gist here. And essentially, I'll switch my face here. So essentially, you always want to factor in the indices in your decision-making process. So maybe a setup looks good, but SPY looks bad. So then maybe you'd be less likely to take that bullish setup just because you think, okay, well, SPY might pull it down and might delay this setup for a week or two. Maybe you should be looking for dip buys on this entry instead of trying to play a breakout, for example. So always keep the overall directionality and your bias on the indices in mind when you're trading individual stocks. And sometimes it can be the inverse, right? Like maybe SPY's looking heavy, and that's why you're looking at gold. That's why you're looking at oil. That's why you're looking at healthcare or these inverse beta things that move the opposite direction of SPY more often than not. These defensive names, stuff like that. So absolutely a good filter. It's great to have in the forefront of your mind whenever you're looking at individual names, touching base on what the index is doing, and more specifically, touching base on what the ETFs that the individual names are a part of are doing. So sure, I care about what SPY is doing when I'm trading healthcare, but I care more about what XLV is doing because that's going to be more relevant. Hope that makes sense. All right, what else we got here? What else we got? Could you expand on what the previous swing is? Absolutely. Yeah, great question. Thank you, Gerald. So for this, I'm going to switch over to my charting software. Bear with me 1 second. Fire up the old trading view. And while I'm floundering around here with my multiple windows on a computer I'm not familiar with, feel free to keep asking questions, guys. I love them. I will answer all of them. It looks like we don't have a huge crowd here today, so you get more one-on-one time. So by all means, please keep them coming. Yeah, Bill, XLV is the healthcare ETF. Yeah, so just there's always going to be a relevant ETF for something you're trading. There's very few things that aren't in a big ETF of some type or another. So you can also use this to gauge the relative strength of your stock versus the basket that it's in. So if I am looking at, I don't know, for example, UNH, I'm not, by the way, I don't like any of the healthcare names right now particularly, but if I was looking at UNH, I would like to see a relative strength to UNH compared to the index. And here's another little tip you can do. You can, on TradingView, and actually I will do this live for you to show you. So my mouth's moving faster than my hands here. Let's share this tab to StreamYard and Discord. And if I do this, there we go. Okay, so we're going to hop into super charts. There we go. Pop this open. We are going to first go to UNH just real quick. And we got some chart gore going on. Let's clear all of that out. Okay. And we'll turn off this indicator. It's a little bit messy. There we go. So when we are talking about valid swing highs and swing lows, we are talking about things like this and like this. So there can be price action within this range. For example, this swing high right here, but I don't really care about this swing high too much. I will keep an eye on it, and price will respond to it to some degree, but it's not what I'm basing a long-term trade off of, right? I think that it's much more important that we watch this big swing low and this big swing high and see what price reacts in those areas here. You are very welcome, Kathy. I'm glad you liked it. So yeah, Gerald, in terms of the swing highs and swing lows, let's go in and look at SPY. Starting to play out. We'll see if we get this move. I'm not sure. But anyways, we have this big swing high here. I'll draw this right on there. And then I will steal this box and mark it down on this swing low. And so this is our trading range. This is the major one here. So obviously this is an extreme example. We can also do something like an hourly, and we'll still see major swing highs and swing lows on there. But just remember, the higher time frame you're on, the more weight we give those levels. So for example, this was a pretty notable swing high. This one, not so much though, because we're still trading in the same range. So I care a lot more about this high than I do about this high. And that's kind of what I mean about being discerning with your swings, or when you're marking out your swing highs and swing lows, because price could very easily come and take this, knock this out, but have trouble breaking through this. This is the one that's more valid, more relevant. And that's just because it's the higher level. It couldn't push high below, so we're still in a range. If this breaks, then the actual hourly range here breaks. So I think that's how I could best explain, a more valid, more relevant high compared to just a kind of whatever high. Because I mean, this candle looked good, but then just wiggled on down there. So always good to keep that in mind, I'd say. And then Bill, I wanted to show you, not sure if this is interesting to you, but for me, it's really interesting. So what you can do, say I want to trade UNH and I'm looking for relative strength in UNH. What I can do, oh, that looks ugly, but anyway, say for whatever reason I was bullish, what I could do is I can take UNH and then I can search for UNH slash XLV. Let's see what we see. So now this chart here, although it looks basically identical, so this probably wasn't the best example, but what this chart is actually showing is UNH's relative strength compared to the index. So every day that this chart is green, UNH is outperforming the index. It's outperforming its baseline, for example, And then every day it's red, it's underperforming. And so by using these charts, you can start to look for relative strength, and it can be great for pair trades. Say you want to long UNH and short XLV because you're not really sure if healthcare as a whole is going up, but you think that if it does, UNH will outperform, something like that. So that is how I use ratio charts. I'll give you one more example. SMH over IGV. This is a fun one. So this is the strength of semi-caps compared to software. And as you can see, they are trying to break out from, look at this, downtrend. Oh, let's make it not white so you can actually see it. Oh, I bet it's a lot easier for you guys to see on a chart like this. That's what I meant to do. So what are we seeing here? Let's run through our system real quick. We have a downtrend line. We have a high volume node here, another one right there. So what are we seeing? We're seeing price come down into a high volume area and show that there are buyers. Came down a little bit more, but showed that there are buyers. We have the downtrend lines. That's adding up confluence, right? And we also have a potential pattern in this starting to look like it wants to become a cup or a mitigation block and get all of these buyers out scot-free up around here in this major swing high. So we have major swing low here. And as we can see, we just barely tapped into it before reversing. So we respected the low. We think price will want to gravitate up somewhere around here, not in a straight line, but that's our incentive. That's our bias for this trade. So because of this, I am bullish semiconductors in relation to software as a service names right now, at least. So just kind of putting what we've learned into action there just a little bit. Moving on here. We got Talk asking, what is your screen time appearance schedule? So right now I'm only streaming 1 day a week for Trade the Pool. That's every Tuesday morning. And I start half an hour before the market opens. And we go for about 2 hours, or we do go for 2 hours there. You can always catch me there every Tuesday. I am hoping that I will have some more screen time, more regular screen time coming up, but can't announce anything yet. But if I do, you guys will be the first to hear about it. I love Trade the Pool and want to be on there every day if possible. So you can also catch me every Friday, 15 minutes after the trading bell closes, the trading day closes. You can catch me on Trader TV, and they're a much bigger platform, tons of viewers. Probably a lot of you guys are from there, so you probably know that already, but you can always catch me there. Great guys. I love hanging out with them. And then right after that, I do these webinars. So that's my screen schedule, screen time appearance at the moment. You can also find me on Discord. Well, first off, you can find me on Twitter at Justy Trades. It's an old handle. It'll change eventually, but JUSTY Trades. From there in my bio, you can find my Discord server that I run. That's where you can find me any time of the day. I don't have a life. I'm always in there in one way or another. So if you want to reach me, you can always reach me there. And yeah, we do newsletters. We do all sorts of stuff. But yeah, check me out there. And DJ2AM saying, you waited for confirmation on BBAI earlier this week and ended up buying it at the high. This is my second time this week doing it, only for them to go straight down, and you don't know why. That's unfortunate, my friend. Let's look at BBAI and see if we can find anything. I will note that I just got long SOUN, which is in the very similar basket here. So I think that it's going to work out for you. This chart still looks constructive to me. So let's see. You said last week you bought it and it ended up being the high. So you were buying around here, it sounds like. And I would imagine you were buying because you saw a break of some previous level. Maybe on the daily we can see. So if you bought at the high of last week, it looks like you bought. How are you red? Isn't it above every price last week? Let's see. Oh, earlier this week. I apologize. Earlier this week. So you bought on this candle probably. Okay. So you were probably saying confirmation would be through maybe this swing high here. And that is totally valid. So let's look a little bit and see what happened. Let's look intraday. Monday. Okay. So then Tuesday we hit here. Spiked a little bit higher on Tuesday and then started to fall off. So what do we see? Let's first off draw this little resistance zone. So that is the area in which it's still having trouble. So for me, I would say that confirmation would be a break of this level and a back test into it and then pushing higher. So confirmation, people have different ways of confirming trades and it depends on their time frame. So for me, what I'm seeing is a couple things. First off, you do have this downtrend line that it's still kind of contesting here. You see that? So let me take this off so it's clearer. You see that top wick there coming down. So it slammed up into it, tried to break out, and now it's kind of waffling around. So how I would view the setup is I think it's bullish. I think it's bullish because this is a flag. It's attempting to break. It was not ready yet. But when it comes down, it's still holding all of the key levels. So for me personally, what I like to do with these types of setups is, oh, is this bad that I say this? I don't like to wait for confirmation as much as I like to bottom pick off of these moving averages and just have stops on a close well through it. And so then often by the time that it's testing confirmation, I'm already in the green. So that's one thing you can do. Another thing you can do is you wait for the pop to come back and hold. So on this daily stick, for example, this big green, that's our big buy candle, right? Where we want to see continuation. So it pushes up. And then if it comes back, we would want to see it hold. So for me, I think waiting for confirmation of a back test would keep you a little bit safer. And we can zoom in just a little bit more and see what happened intraday and maybe why you got caught. You were buying Monday or Tuesday. And I mean, it's tough when it's holding VWAP like this. It's holding short-term moving averages. It seems like it's breaking out for sure. So what I would say the confirmation would be is a close of a significant candle over this on significant volume. Another thing we can look at on the daily here is that we did not get significant green volume. We actually got significant red volume. So that's something to consider. Probably just saying, hey, we're not ready to go yet. But this volume, despite being a slightly red day, this was a nice above average volume day, and it posted a big bottom wick. So because of this, I think that it's just in a holding pattern, and it likely will push higher. I do like this name. I also like SOUN, which is a very similar name with a very similar chart. As you can see, this one's getting very tight too. And this compression, this one's a little clearer where it's testing this downtrend line, right? But it's still holding moving averages. It'd be nicer if it was over this, but for the most part, it is holding these moving averages. So that's kind of how I would view this. Let's see what else we got here. And let me know if you have any more questions, brother. I'm more than happy to work with you a little closer on this trade, either here or in Discord or whatever, and we can talk about it. In general, though, I don't think it's bad unless, what the heck is BAI? BBAI, there we go. I don't think it's worrisome unless we lose this swing low here at 367. So that's a big percentage move. But on the other hand, if it goes, you're going to get a really big move. So this is a great name to essentially have a small position in and then build into it. But the other thing I just want to mention is look at this volume profile. It's a nice P-shaped volume profile, bigger at the top, smaller at the bottom. So it's building out volume here for a base and a push higher, I do believe. So right now it's just kind of stuck in the mud, right? It's stuck right in the middle and it's not quite ready to push away and kind of break out and leave the nest, so to speak. Once it does, you will get an explosive move. I see a lot of incentive to rip this thing significantly higher. So I do like the name. I do like the setup. Maybe you could consider averaging in a little. If it's not if it's a big position already, but if it's a small position, you could consider averaging down off of these key moving averages here, the 20-day moving average and the 9-day moving average. So yeah, that's how I would kind of frame this. Hope that helps. All righty. Trader X, very nice, great review. Thank you so much. I need to master learning not to hold too long. Thankfully profitable, but I have a few day trades that have turned into swings. Yeah, the whole classic, it's breaking out right now. And then 2 days later, well, it was always a long-term hold, I do that too, don't worry. So I do it a lot less now because I do stick to my rules for the most part. I'm not perfect for sure, but I think just what would really help you is just systematizing this stuff and just really drilling it. Because then every single time you practice a good cut of a position, it'll hurt in the moment, but it'll start to build confidence of you going like, hey, I know this is the right thing to do. Then sounds like you do a good amount of day trading. So then you don't want capital tied up in swing trades when you could be using that to leverage your edge in day trading. So totally with you there. It's just, I think another thing is maybe an indicator that really helps me is Bollinger Bands or linear regression bands, some kind of way to track when things are overbought short term. So then you can say, okay, I'm in a trade, it's working. I'm not sure exactly where to sell. Maybe this will help me kind of assuage the FOMO that it might just go straight vertical when you see it trading into a 2-time standard deviation band on your linear regression chart, for example. So something like that can help me very easily say, okay, this thing's in an uptrend. I am not going to miss it. I got my piece. I'm going to take the profit. And then when it comes back to the equilibrium of these bands, so basically it pushed the top of it. When it comes back to the equilibrium, it should back test and I should get a position there. And hey, maybe it's not as cheap as my first entry, but it's much safer, right? So I think something like that might be something to experiment with, either linear regression bands, Bollinger Bands, or ATR as well. So that's just like the average true range. So then you can say, hey, man, we are double the average true range. This was a great day, but this thing's running hot. It's bumping into the daily Bollinger Band. It's bumping into, I usually go the 4-hour Bollinger Bands. I'll watch the 1 hour and the 4-hour Bollingers or linear regression channels for these kind of swing trades or, like short swing trades, like 2 days to 5 days, something like that. And so, yeah, that's a system that can be really helpful. I would recommend taking a look at that. All right. More praise. Oh, absolutely, DJ. Do your thing. Do your thing. I really appreciate you being here, you and everybody else. This has been a lot of fun. I think that this is just about my time. We've been on, wow, almost 2 hours. So yeah, I am going to head out and enjoy some nature. It is beautiful out here. I hope you guys all have a great weekend. I'll pop into the Discord for, let's call it 15 minutes here. If anybody wants to hang out, we can totally do that. But I think we are wrapped up here. This has been a great week 2 of our 6-week class. Next week, I'll be coming back at you with a lot more stuff. I have vacation brain, so I cannot remember the topic, but it will be posted shortly. I've given it to the graphics people, so it'll be on Trade the Pool under the events. It'll be a lot of fun. It'll be building off of what we've talked about this week and the previous week, and we're just going to keep on building. So thanks for being here. Thanks for building with me, and I am going to head out here, guys. Have a great weekend.